Hello and welcome to this Linchpin online VAT seminar. I'm very pleased to welcome all of you on this updated VAT online training program. Now, we have been conducting this VAT training since 2016 and we have been only doing face-to-face VAT training, and hence we decided that not all of you can join us there, and we are here with on-demand VAT online seminar. Let's see what is the agenda to cover. And first of all, my name is Mirza Farooq Beg. I am the CEO and lead consultant here at Lynchpin Training. Uh, we have to cover a lot of things, and we'll start with very basic itself. We'll have overview of VAT, and we'll see how to get VAT registration. We'll see the VAT calculations involved and the all important transition rules here. Here it means that if I have a contract started in 2017 and finishes in or executed in 2018, how VAT would be impacting me in this case. And we'll also see zero rated exempt supplies, the legal frameworks. Here we'll have a minor overview about the VAT laws here, and we'll see that when to record VAT. Okay, should I record VAT, which means that place of supply rule as well as date of supply rule itself. We'll see VAT on imports here, and we have a whole session dedicated on free zone, and then and at the end we'll also see that how to face VAT audit, fines, penalties. Unfortunately, we all have to face uh, these sort of issues in case if we are having the VAT compliance. And we'll also see that how and when we can appeal to FTA in case we are having any a disagreement with VAT audit itself. To start with, we always say that what is VAT, and to understand this, we say what is not VAT, what would be excluded from VAT. And it's much more easier for us. So what won't be VAT is that in case there is any salary income, there is no VAT on this, which means the businesses would not be subject to VAT as and when they'll be paying their salaries. VAT won't be a tax on the business profit. So in case if I'm making a loss, even still I have to charge VAT. VAT won't be a tax on wealth what I have accumulated, which means that if I'm sending funds to my home country, and in case if I am in that case, VAT won't be charged on the whole funds what I'll be sending. Indeed, VAT would be there on the fee of that in case if there is any. For example, if any exchange house would be charging me any fee, and mostly VAT won't be a cost for the business. Now, this is very important to understand. There is a myth that VAT is an expense for the business. Yes, VAT compliance is it can be a cost, but VAT itself mostly will not be a cost to the business unless until you are selling exempt supplies, which we'll have a discussion on, or barring few expenses on which you won't be able to claim your input VAT. So before we start this, I'll just explain you that what exactly is this whole phenomena. Now, the state government wanted a tax. Wanted a tax from whom? Wanted a tax from the end consumer. Consumers are all of us in individual capacity. But the whole thing is that business, the end consumer and the government here do not deal with each other unless until we are applying for a visa here or any such item. Now in between we are the businesses. Now all the businesses, the government has asked that you the businesses are selling to the consumers. Whosoever you are selling, you charge them 5% VAT. Now as and when you have charged this VAT, you will pay it back to the state government. So my obligation here is what? My obligation is only one, and that obligation is charge VAT. I have to charge VAT to the end consumer, and ultimately what I'll do, I will pay it back. So it means that the indirectly the state is collecting VAT from end consumer via us. Us means the the businesses here, and VAT won't be a tax on me as a business, and we'll see onward how it will get proved also. So if we exclude all those things, and so what is VAT then? VAT is a tax which would be on my supplies as and when I sell anything, which could be my goods or services, or as and when I import anything. So these are the two items, item 1, item 2, which means as and when I do any imports, I will be subject to import VAT, and as and when I sell anything. Now here the word is supplies. It's not only sale. It's very important to understand. Uh, Normally I sell whatever is my main activity, but I'm maybe selling something else, or I may be supplying something else. Let's take an example of any scrap items, any fixed asset. All those would also be subject to VAT itself. Now, here we also see that VAT rate is 5%. Now, this VAT rate is 5% across all GCC states itself, and VAT is already implicated on 1st of Jan here. Not all businesses would have a requirement for VAT registration, which means there are certain companies which won't be required to have a VAT registration, and we'll see at the end at if we are in such entities, what is a drawback for us and what could be the potential benefit for us. So VAT at the end is imposed on imports as well as local supplies as per article 2 of UE VAT law itself. So VAT starts with first seller now, and it flows through the whole supply chain. Let's take an example. Take a look around you and you will definitely find any wooden item. So let's take an example of a table here. So if I have a table, what is my supply chain here? Let's start with first seller here. First seller would be normally a farmer. A farmer is someone who will be selling wood. From farmer it comes to a factory. From factory it goes to a wholesaler. From wholesaler it goes to a retailer, and from retailer it comes to the end consumer. Now the end consumer is the one who will ultimately absorb this VAT, and we'll see how it works also. So all of us who will be selling something will be charging VAT at 5%. It doesn't mean that it will multiply. We'll simply be charging VAT on our selling price itself, and at the end it is the end consumer who will ultimately absorb this VAT. So anywhere here, if you are falling in this whole chain, you should understand your obligation. Make sure you take a note of this. Your obligation is only one: you have to charge VAT. You have to charge VAT. Charging is my obligation, and at 5% itself. So whenever I'll be supplying anything, I have to charge VAT. You should, and all of your company staff members should remember one thing: your obligation is to charge VAT. If you will not be charging VAT and you are here somewhere in this whole chain, you may be subject to fines. Let's now see that before we go through into details of VAT, we understand four key areas. First one is called TRN. TRN is my tax registration number. This is a 15-digit code, okay? 15-digit code issued by FTA, the federal authority here in UAE. Now, once you get a TRN, I'm sure that most of you who have already applied for VAT registration, then you must be having it. You should embed it, your TRN, on all your invoices. On all your tax invoices, your TRN must be there. One thing. Second is, you have to ask all your suppliers that as and when your suppliers would be issuing you a VAT invoice, they have to include it also. So my TRN should be on my invoices. It's very important, as well as my suppliers invoices also. Second concept is called input VAT. Now input VAT is whenever I buy anything from my suppliers, he will be charging me VAT. It could be on my inventory, fuel expenses, station expenses, office rent, any such thing. So I will be recording it separately. Now you may be here having a thought that we just have a discussion that VAT won't be a tax on the businesses. Then why somebody will be having a tax when he'll be selling to me? I'll explain you afterwards. Just understand the concept that input VAT is something which somebody will be, if as and when he'll be selling you something, he'll be charging you that. The output VAT is as and when I sell something. So in short, it is when I sell something, I'll be charging output VAT. When I and as and when I'll be buying anything, I would be paying the input VAT. Now at the end, let's assume there is a month end and you have got your output VAT which is for 100 and your input VAT which is 60. What you will do, you will subtract your input VAT from your output VAT and you will pay the balance amount of 40. So hence it is just established that even though you are paying some input VAT, you will adjust it from your output VAT and you will pay the balance amount itself. And it would be through filing VAT return itself, and we'll see at the end that how VAT return and what are the contents for it. Let's see an example here and we'll be just understanding that how VAT flows through the whole supply chain. Let's start with a forester, and here we have assumed that a forester is selling to a factory and forester would be charging 5% VAT on that, and he has no input VAT. We have just assumed, although he may be having a purchase of seeds, water, any such thing. So he paid the full amount to FTA. Next, sale of a forester is now a purchase for a factory here. Now this output VAT is now input VAT for a factory. Now factory onward sold to a wholesaler and they have now charged them output VAT. Now factory would be adjusting its input VAT from its output VAT and paying the balance amount. Now it comes to a wholesaler. Now the input here, output here becomes input here. A wholesaler would be selling to a retailer here and he'll be charging him output VAT where he'll be adjusting his input VAT and paying the balance amount again. From wholesaler we move to a retailer. A retailer is now ultimately selling to the end consumer and he's charging him a VAT and output VAT also of 5%, adjusting its input VAT and paying the balance amount. Now just take a pause here and calculate total for this whole area. You'll see that we as end consumer has paid a VAT of 30 and it is exactly a total here. So whatever VAT we paid was actually collected by FTA already through this whole supply chain. So ultimately we are the ones who are the end consumer who are absorbing this whole VAT. The businesses here, and here are just adjusting their input VAT. So input VAT is adjusted from output VAT and the balance is paid. Nobody has absorbed this VAT except the end consumer. So hence it is proved that VAT is a tax on end consumption and it is collected via the whole supply chain itself. Let's now see that at the end of the period, it could be a month or a quarter, you will calculate your output VAT, you will calculate your input VAT, adjust it against your output VAT and you will ultimately pay or recover the VAT from FTA. Now final consumer, it means that any person who won't have a VAT registration with FTA, mostly it would be individuals who won't be having the VAT registration, but there could be certain sort of the businesses who may not be having the VAT registration. In all such cases, VAT would be a cost for the business. So again, if a business won't have a VAT registration number, then in that case any VAT charged to them by any business would be an expense for them. They will not be able to claim VAT unless until they have a valid VAT registration. Let's take an example here, and for simplicity's sake, again we have got our sales which are 20 million and we have got the purchases which are 15 million and the VAT rate is also here. So if we calculate the output VAT, it comes around 1 million. If you calculate input VAT, it is around 750. So ultimately once we adjust it, we will pay 250,000 at the end of a tax period. Now the whole purpose for this example is that at the end of a month or a quarter, as and when applicable, as and when you will be filing the VAT return, you have to have all this exercise. So your accounting software must be able to export all this information and you should be able to fill in the online VAT return. Let's now see that once you will be filing the VAT return, you can have two scenarios. Either you will pay the VAT, or you may claim a refund. Now if your output VAT is more than your input VAT, you have to pay. In this case you have to pay. But there could be a scenario in which your output VAT is less than your input VAT. In that case you can also get a VAT refund here. Now VAT refund, mostly, let's take an example of an exporter. Now an exporter would have zero output VAT here. The reason is that exports are zero rated. We'll have a discussion it afterwards, but for simplicity's sake here, just assume that an exporter, a typical exporter, won't be having any output VAT. So he will only be having an input VAT. So in that case, he'll always be claiming a refund from the FTA itself. So he won't pay anything unless until your output VAT is exceeding your input VAT. In that case only you will be subject to pay the VAT to FTA with VAT return. Now, claiming of input VAT, this is very, very important concept. The reason is that many businesses here are assuming that we cannot claim VAT on office expenses, and we can only claim them, as and when we sell any item. Now, please understand that you can claim VAT on all your eligible business expenses. What it means, mostly it would be including all expenses which like office rent, supplies, stationery item. You may have a purchase of inventory, and any tax paid on imports also. The exclusions are if you have paid anything for entertainment, or if you have any expense for the private use of staff or the owners. Now it's very important to understand that entertainment of any sort, for example, you take your clients for an outing, you take them for a club, or you take them for a lavish party, you cannot claim VAT on all such expenses. And also on the private expenses of your staff, you cannot claim any input VAT if it is paid for staff, unless until such expenses are either legal obligation, or a contractual obligation, or a business practice. The business practice must be documented in a policy. Let's take an example. You are giving meals to your staff members, or you are giving meals to your labor accommodation. Now in that case, unless until it is a legal obligation, a contractual obligation, or a business practice, you won't be able to claim the input VAT. So make sure you should very well understand this concept, that you can claim on all business expenses except entertainment and private use. Now also here you need to understand that if you have purchased any item and you have not yet sold it, you can still claim the input VAT. You need not to wait for it to be sold ultimately. VAT registration, let's now see that how this VAT registration works. If you are operating in this country, first of all, if you are a resident of UAE, you have a mandatory requirement here. Number one is mandatory requirement in case your taxable supplies are more than 375,000. Now what is a taxable supply? Let's understand it here, that a taxable supply includes all my standard rated supply, which means any sale on which I'll be charging VAT on 5%, any sale on which I'll be charging VAT at 0%, and my imports would also be included in this. Now if I'm selling any capital asset, which means if I've sold any fixed asset, I'll not be calculating it to have a certain my VAT threshold. I'll give you an example here. Let's say I'm establishing my requirement that should I register for VAT or not, and my sales here is 180,000, and I have sold some of my old furniture items. It could be my office furniture, equipment, any such thing, and sale of my capital assets is around 300,000. Now when I'll be calculating the value of my supply, I won't be including my capital asset sale. It would only be my taxable supply. Now once I have established it, I have to apply for the VAT registration. Now second requirement is that, or second scenario is that I can also have optional registration. Now optional registration means that if my taxable supply value is between 187,500 to 375,000, I have the option to apply for the VAT registration. Now it's very obvious that in case if I have to claim my input VAT, I have to apply for VAT registration itself. So I'll still be happy to apply for this, the voluntary VAT registration, because I'd be able to claim my input VAT. Next interesting requirement is that if I'm a non-resident business, which means I does not or I do not operate here in UAE. In this case, I have to apply for VAT registration. There is no threshold requirement. I have to apply for it unless until there is no other person in this country in UAE who is paying tax on my behalf, which means what, that if somebody is paying VAT on imports, I will not be required to have the VAT registration. I mean, who is outside this country, who is supplying something here, I do not have any business place here, but I am a non-resident and I am supplying here in UAE. For example, there is an entity in UK, they are supplying something in UAE, and if on import somebody is paying VAT on imports, I'm sitting in UAE, in UK, I won't have any requirement to get the VAT registration here. But if nobody is here who is paying VAT on the imports, then in that case, I may have a requirement. It is very easily applicable if somebody is supplying online here and nobody is paying any VAT and it's just an electronic item. So in all such complicated cases, VAT obligation would be established here. In case if you are having more than one companies, you can apply for VAT grouping. What is a scenario? I've got company A, B and C. Now all companies must be in this country UAE. Let's say it is happening, then I have got a common control and all companies are having a relationship with each other, which means that it could be a common owner or I have got same management here. In all such cases, I have I have an option to apply for VAT group. What it means that it won't be my accounting grouping. My accounting grouping would still be as per IFRS, but here I'm establishing a VAT group. What it means? It means that once I establish a VAT group, if I'm supplying within the group after getting approval from FTA, if I'm if I'm supplying within the group, there is no VAT implication. I won't be charging VAT to my group company. Now it is very beneficial in case if you are very heavily transacting within the whole group. Let's give you an example. Here is a hotel. Now this hotel owner also have a car leasing company. Now car leasing company is heavily supplying to the hotel. Now once they have the grouping, as and when this car leasing company would be supplying to hotel, no VAT on this. Okay, but in case if we if we do not have the VAT grouping, in this case what will happen? In this case, as and when I'll supply, I'll be charging 5% VAT. So there's a huge benefit for all such companies who are owned by same owners and they want to opt for it. In this case, only as and when I'll supply outside the group, I'll be charging 5% VAT on this. Else I won't be charging. But there is a flip side for this also. Let's see this. There are three companies. At the end of a period, I have calculated their input VAT, output VAT, all combined, and we have established that their group obligation is 600,000 as a group. But internally, we know that 100 belongs to company A, 100 belongs to company B, and 400 belongs to company C. Now, if company C defaults internally, still company A and B have to pay this full amount, which means what? As and when we form the group, all obligations becomes group's obligation, which means all surviving entities have to pay VAT on as and when FT would be asking them. So make sure you group only the entities which you really own. Let's now see that who will be charging VAT. Very simple answer is that anyone who is having a VAT registration. So VAT registrant business must be charging VAT, and so it's your obligation to ascertain that how much is your current sale, and you will establish on your own whether you will be charging VAT or you will not be charging VAT. Next one is that who can claim input VAT. Now this is important. Make sure you remember one thing. Your obligation is to charge VAT. You have to charge VAT. Claim is your option. Claim is your option. If you will not want to claim VAT, FT would be happy for that, but charging is your obligation. Now who can claim this input VAT? A business must be a taxable person, so anybody who does not have a TRN, he'll not be able to claim the input VAT. Tax should be charged correctly, which means what? I just assume that in the beginning, maybe there are some entities who will be making invoice by hand or in Excel. In that case, there are high chances of errors there. So please make sure that you calculate and you can see that 5% VAT is appropriately being charged to me. Next one is that whoever is buying, the purchaser or whosoever is claiming the input VAT, he must have a documentary evidence, which is ideally a tax invoice. So a tax invoice must be in place with you if you are claiming your input VAT. And input VAT can only be claimed if you have already paid or you intend to pay your supplier. So VAT law specified that uh, you know unless until you have intention to pay your supplier, you won't be able to claim your input VAT. Now either you have already paid or you have intention to pay. Now why this is important? Because if you won't pay in 6 months time from the supply date, the supplier has an option to claim you as a bad debt. Now here we need to understand is that VAT is on accrual basis, which means what? We don't wait for our client to pay us the money, but in between, if there is a VAT return day, we have to pay that money. So let's assume I paid some amount on behalf of my client already, but afterwards he's saying I'll not pay you back. In that case, I will claim it as a bad debt. So as and when I'll claim it back, I have got my funds back from FTA, and you as a purchaser has also claimed this input VAT. So FTA imposes a condition that if you do not intend to pay your supplier, you should not claim your input VAT. In all simple cases, normally all B2B transactions, you will be able to claim your input VAT as and when you get a tax invoice, because we assume that you are a going concern and you will pay your suppliers in time, or maybe you have intention to pay it. We'll have a further discussion on this as and when we'll be having our section for the bad debts. Let's now see the important area here is that how VAT impacts us if we have a contract which we started in 17 but we are executing it in 18. Now make sure you understand one thing. If you have a contract which you started in 17, or you got advanced payment here, or you got invoice issued, but if it is executed, this is executed in 18, either in full or in parts, or supply is accepted by recipient, which means if you have supplied the item in 18 but you have invoiced in 17, or you got advance in 17, still it will be subject to 5% VAT. Many businesses have actually assumed what, that if we pay in 17 and we get a supply in 18, it will not be subject to it. A common example would be your office rent. Let's say you have a rental agreement which spans from 17 to 18. So 5 months are falling in 18 and 7 months are falling in 17. In this case, the portion which is falling here in 18 would be subject to VAT, and the portion which is falling here, there won't be any VAT itself. Now This is as per Article 80 of UE VAT law. Now Article 70 of Article 70 of Executive Regulation, stipulates that if you are silent on some item, for example, in 17, you agreed that you will be entering into a contract, but you are silent about VAT. There is no clause on VAT. In this case, if your client can claim his input VAT, you can still charge him VAT. But if your client cannot claim his input VAT, in this case you won't be able to charge them VAT. In this case, VAT would be a cost for you. I'll simply give you an example here. Let's say that I have a contract in 2017 and I'm selling to individual. Now individual will not be able to claim the input VAT. The price I agree with him was 100,000, and either he has paid me the amount or I have issued him invoice and we have entered into the contract. Now his supply is executed in 18 because I was selling to individuals and he cannot claim his input VAT. So now my final value of supply would be 100,000 and I still have to bear this 5% VAT in this amount, which my client will not pay me. So it is like for B2C transaction. But if I'm selling B2B, in this case, what will happen is that I will assume here that my client can claim the input VAT and all my prices are plus 5%. Now, of course, to happen all this, you must have sent a letter to your client asking them about their status for that. If they give you a reply in 20 days and you will be able to establish that. If they are silent, then you will assume that they'll be able to claim this input VAT. If you want to study further on this, I would strongly urge you to go and see Article 70 of Executive Regulations itself. Let's now see that if I'm supplying the goods or services, how to establish it, because it's very important. This will affect when I'll say at when to record VAT. When to record VAT will have a high dependence whether I'm supplying services or am I supplying the physical items. Now let's see a definition here. The goods means if I'm passing on the ownership or I'm giving a right to use the ownership or as an owner. Anything which won't fall here would automatically be a service. For example, accounting services, consulting services. Now for the goods, if you are seeking for an example of right to use the property, I'll give you an example. If you are taking a leasehold item. Now a leasehold item would be for let's say 80 years. Now in this 80 years, you have all the rights to use this property as an owner. So this would still be treated as supply of the goods. Now collectively, supplies can be divided into main categories here. Number one, number two, a taxable supply and an exempt supply. A taxable supply can further be subdivided into two categories, which is a standard rate supply and a zero rate supply. The standard supply means on any item on which I'll be charging a standard rate VAT. Zero rated supplies on which there would be a VAT but at 0% itself. The examples here for a zero rated would be, let's say, school fee, zero rated, air tickets, zero rated. What else we have? We have got in case what else we have? School fee, air tickets, export of the items. All such things would be zero rated. Other things would be falling here. Now exempt supplies are very interesting phenomena. On exempt supplies, there is no VAT, which means end user will not pay any VAT here. Now you may be having a thought here that in both the areas here, me as end user won't pay anything, but for supplier it is altogether a different world. Why? If I am supplying exempt supplies, I cannot claim my input VAT. So exempt supplies are the example would be, life insurance services, interest based banking services, all such things are exempt supplies. So all such supplies won't be able to claim their input VAT. uh, Most of the businesses in this country would be falling here, or who are exporting falling here. So all of you can claim you. Okay, so here you can claim your input VAT. Here you cannot claim your input VAT. So make sure you should identify, understand that whether you can claim your input VAT, or or you cannot claim your input VAT. Now if there is a company which is only supplying exempt supplies, you won't be required to have VAT registration, because to apply for the VAT registration you have to have a a taxable sale of 375k or more. In this case, if you are supplying exempt item, you then you cannot apply for VAT registration. Next important area is value of supply rule. Now you have to understand that VAT is basically charged on value of supply, which in simple sense is my selling price. Now, if I'm selling in cash, it would be amount received or on which I am issuing the invoice. If I'm exchanging the goods, in this case, which simply we call as a barter trade, in this case, it would be on market value of the incoming item. Let's take an example. We are a training company. We go to a furniture house. We give them a training. The furniture house is now saying that we will not pay you in cash. Rather, we will supply you furniture. Now, I have to issue my X invoice. In this case, what will happen is that I will be charging them 5% VAT on furniture value. Okay, value of supply includes all expenses, taxes which are recovered by supplier from the client. Now here explicitly the economic department have issued the clarification that there is no VAT on municipality fee. Okay, this is applicable in case if you have a hotel business or a restaurant business. So you will be definitely be charging your client the municipality fee, but you will not be charging VAT on all such items. Let's now see that value of supply, in what cases we can adjust it. This is very important, and here we'll have a discussion on the accounting entries also for VAT. Now as and when if we are offering a discount or a deduction to our client. Now it could be in case of a discount, a dispute, a bad debt, any such thing. Let's first see that how this is applicable. Take an example of a seller and a buyer. As and when I sell an item, let's assume I sold an item for 100. So what accounting entry I'll be recording? I'll be crediting my sales by 100, and I'll be having a record of my output VAT by 5, and I will be debiting my account receivable by 105. A buyer would also be having this recording entry. He'll be recording his purchases by 100. He'll be having an input VAT by 5, and he'll be having an obligation of account payable by 105. Let's assume all of this was in Q1. Now in Q2, my client is saying I will not pay you back the half amount for some odd reason. Let's assume it is a discount, or it could be a bad debt item, any such thing. Now for some odd reason I have accepted it. What I'll do, I have to adjust my output VAT if I am a seller here. What I'll do is that first of all, let's say it is a discount entry, so I'll record a discount expense here, debit 50, because here I recorded 100, and then I have to adjust my output VAT by 2.5 because half of it I won't be having, and account receivable would be adjusted by 52.5. Same entries buyer would also be doing. He has to reverse his input VAT, and he has to record the accounting entry for this whole process. So he'll be recording what? He won't pay half of the amount, so he'll be debiting accounts payable by 2.5, and he'll have a purchase discount by 50, and he will credit his input VAT by 2.5. In this manner, we have now adjusted our VATs, what we recorded in both cases. This is very important, and as a consequence here, we as a business will issue a tax credit note, and as and when we have the credit note here, we will be recording this entry. Now this is very important. We should understand that a seller has to record this so that he should not be overpaying it, and a buyer has to record it here so that he should not be overclaiming. Now overclaiming is subject to fine. So if your supplier has already issued you a credit note, you have to record a reversal of your input VAT also. Second area is that in case if you have any payments made on behalf of the customer, you can adjust your value of supply. Let's take an example here that I'm a lawyer and I'm filing a court case or any expense on behalf of my client. In this case, I may adjust the value of my supply in, and I won't be charging VAT on the specific amount that I have adjusted. Let's now see that in what scenarios bad debts can be recorded. Now it's very important that if I want to record bad debts as per Article 64 of UE VAT law, I have to fulfill 4 conditions. Now these 4 conditions are very important. First thing is that you have already supplied your items, your services have already been supplied, and you have already paid VAT, which means if you are a monthly VAT return payer, in that case you have already filed as well as paid the VAT. Next one is that you have accounted for the supply as a bad debt in the accounting system itself. Next one is you have it has already been more than 6 months from the supply date, and the most interesting and very surprising condition is that you should have notified the recipient at your supplies are being now treated as a bad debt. So in that case, maybe if I'm your client, I'll be sending you a thank you letter for this, but I'm sure that you will only be claiming it back in case you are fully certain that you won't be getting your money back. So all these 4 conditions, make sure all of these have to be in place before you adjust your output VAT on account of bad debt itself. Similar conditions are for the buyer of the goods. Anyone who will be buying the goods, he has to adjust his input VAT also. Now in that case, of course, the supplier has already reduced the output VAT, and he has got a notification from the buyer itself. Of course, we have already seen that the supplier has to issue a notification to the buyer. In this case, you have already received the services or the items from the client, and you have already claimed your input VAT, which also means that you have already filed the VAT return. Next condition is again the same, that it has been more than 6 months that you have not paid in full or in part the value of your supplies. So if we just sum up our first session here, it is very important to understand that VAT is self-assessed. Nobody will be watching us. We on our own have to maintain all accounting requirements, documents, every item. And to achieve all this, we need a strong accounting system. It is very important. You must understand that 5 years is a requirement to maintain all accounting records. So you should need a robust accounting system. Although using accounting system, system won't be a requirement, but it is highly recommended that you should upgrade or you should have a VAT compliant accounting software itself. Thank you very much. I'll see you in next session in a bit.